Okay, in Chapter 10, we're going to be looking at property acquisitions and cost recovery or depreciation. We're going to explain the concepts of basis and adjusted basis and describe the cost recovery methods used under tax law to recover the cost of personal property, real property, intangible assets. We're not going to cover natural resources in this presentation. Determine the applicable cost recovery or depreciation life, method, and convention for tangible personal and real property, and calculate the deduction allowed under the basic system called MAKERS. Explain the additional special cost recovery of 179 bonus listed property and calculate the deduction allowable under these rules. And then explain the rationale behind amortization and the 4 categories of amortizable intangible assets and calculate it. As I said, we're not covering Objective 5. So we're focusing on businesses here and real estate, rental real estate. Businesses must capitalize the cost of assets with a useful life of more than 1 year. So if you buy something, you're going to use it more than 1 year, we must capitalize it. Then we recover the cost of that asset, meaning we expense that cost over the time limit we're going to use it. Depreciation is what we call the expensing of tangible assets. Amortization is what we call the expensing of intangible assets. And there is depletion, which is the expensing of natural resources. Businesses use these methods to recover the cost of the assets they paid for due to wear and tear and obsolescence of the assets. So we're not allowed to deduct the expenditure for these assets, as we saw in Chapter 9, the year we buy them. But we are allowed to deduct an allocated amount of that cost each year as we use them. As I said, depreciation is when we expense the cost of tangible personal and real property. Let's clear up any misconception right now. What is personal property? It is not assets you use personally. Okay? And this is the word that they use to describe non-real estate property in business. So non-real estate, equipment, vehicles, machinery, furniture, vehicles. So everything that you use that's a tangible asset you're going to use more than a year that is not a building or land, basically. Real property then is real estate. This is your buildings, whether it's a commercial building, an apartment building, a warehouse, a garage, any kind of real estate. Amortization is what we use to describe expensing or deducting the cost of intangible property. And then, of course, depletion. So make sure you understand what we're talking about here. It's not personal use property, it's personal property. And that's, I know it's a silly word. I almost said stupid, right? But it is a word that's used to describe something that we do use personally, but that's not what it means here. Now, let's talk cost recovery as far as what do we get to deduct. Basis for cost recovery is what we call that. Once the use of purchased assets is started, now you can start recouping the cost of the assets or calculating depreciation for tangible assets. Cost basis reduces when cost is recovered through cost recovery deduction. So remember, when we're selling an asset, we use the asset's adjusted or tax basis. So an asset's adjusted basis will be how much you initially paid for it, plus improvements, minus the total depreciation or amortization you've taken. So you've got to keep that in mind. And we're just bringing this out to you. That's what adjusted basis is. It's more than just what you pay for it in a business. You add any improvements you made to it that will last more than a year and subtract all depreciation taken on the asset and the improvements. Take a look. Scrap Happy, a scrapbooking retail chain, purchased an old office building for $175,000 for use in expanding its current operations. It spent an additional $15,000 painting and remodeling the building to prepare it for its opening. There's the first scenario. 2 years later, an employee discovered that several leaks in the roof were causing serious water damage, and the company spent $50,000 to re-roof the entire building. Every 6 months, Scrap Happy pays $500 to have the carpet professionally cleaned. So let's take a look and see how Scrap Happy handles these. I think. There we go. What is the original basis of the building? What effect do the other two transactions have on the original basis? Well, the initial cost was $175,000. And by the way, it doesn't matter if you're buying a new or a used, previously used item to calculate cost recovery. So even though this is a quote used building, they paid $175,000. The additional painting and remodeling to get it ready for its first use added to the cost of the building, and that's the original basis. That's the quote total cost. The $50,000 re-roofing expense is added to the basis as an improvement. This results in a restoration of a major component of the building. So any expenditures after you start using that will last for more than a year, they are capitalized as well, and this will be depreciated. The biannual carpet cleaning is a routine maintenance to keep the rugs clean. That will be immediately expensed. That is not added to basis. Okay, again, personal assets. Make sure we understand that. Personal property is comprised of tangible assets, automobiles, equipment and machinery, furniture, any other vehicle. Real property is buildings and land. Intangibles are non-physical assets. We know that from our prior course work. They're an asset that's basically invisible, does not have physical substance. And then natural resources are commodities that are considered valuable in their natural form. Oil, coal, timber, and gold, just so you're familiar with that. And there's the cost recovery we perform under each type. So we're going to start with personal and real property. Before 1981, tax depreciation methods closely resembled financial accounting methods. So it's basically pick one of those, do what you want. There was no official tax system. But in 1981, Congress introduced a tax depreciation system called accelerated cost recovery. Most assets under that system have fully depreciated, so we will not be learning that. In 1986, after the major tax code recodification under Reagan, and someone was taking tax accounting at that time, a new system was introduced, and I learned both when I was taking tax. Talk about confusing, but it's called Modified Accelerated Cost Recovery System, and that is our staple system now. That is what we're currently using to depreciate tangible properties. And we pronounce it makers. And they even put the little quote there so you understand. The acronym is MACRS, and we say makers. To compute makers depreciation for an asset, the following needs to be known. The original cost, what type of depreciation method you're going to use, because you actually have two to choose from. How long is the asset's life? And different from financial accounting, we don't get to decide the asset's life based on how long we plan on using it in our business. It's actually defined in the tax code. So you'll be told the life of the asset depending on what you purchase. And then the applicable depreciation convention that we'll discuss determining with the personal property, we use what's called half-year convention or mid-quarter convention, and then real property, your buildings, mid-month. So we'll talk about what that means. So personal property depreciation is our first area. Includes all tangible property such as computers, vehicles, furniture, machinery, equipment, other than real estate, real property. Personal property, not real property, and personal use property are not the same. So there we pointed out to you. Be careful of that. So these are personal property assets from our first bullet point that are used in a business. They are not personal use. If the assets are used by you personally, not in your business, it'll say personal use. So that's how we keep the two separated in taxes. Under makers, you actually have a choice of 3 acceptable methods for depreciating these types of assets. 200% double declining balance, 150% declining balance. And I could tell you, based on the life of the asset, the type of asset, it will be either of those two. The other method is straight line. So if you don't want to use an accelerated method of depreciation, if you want to spread out that cost evenly, basically, you can use straight line for personal property. We're not really going to deal with straight line because most people use 200% declining balance. For financial accounting purposes, an asset's recovery life is based on what the company feels. That's what the first bullet says. But for tax purposes, the cost recovery or the life is predetermined by the IRS. And actually, Revenue Procedure 8756, 1987, which helps taxpayers categorize each of their assets based upon the property's description. I am not going to make you look at that. It's very lengthy. And of course it would be because they're trying to guide you on every type of possible asset that could be purchased. We are going to focus on a few, and we'll define that in a second. Once the business has determined the appropriate categories for its assets, it can use the revenue procedure to identify the recovery period. For instance, here's office furniture. This is a little part of Revenue Procedure 8756. It's the middle column that we focus on. So once office furniture, fixtures, and equipment, and it gets very specific, this includes items that are not a structural component of a building, desks, files, safes, communication equipment. Does not include communication equipment, though, included in other classes. So some communication equipment could be 5-year, but it's 7-year, a 7-year life, and that's one of the common categories we'll be dealing with. The other is the 5-year category. Look at here, light general purpose trucks includes trucks for use over the road. What we're talking about here is basically every truck but a tractor trailer. Tractor trailers are 3-year property. So what are our common cost recovery periods available? Well, we're going to see a table in a few minutes and we'll see all the different ones. But some lives are for very, like I say, exotic or extraordinary types of assets. Most companies don't have them. The two major recovery periods are listed right in front of you, the 5-year and the 7-year. So the 5-year is where that's the life of our cars, our light general purpose trucks, including our dump trucks, computers, and the computer's peripheral equipment, printers, routers, databases, database storage, whatever. I don't know all that stuff myself, but any kind of costs associated with those would be considered 5-year property. That's the recovery period. Office furniture, fixtures, equipment, machinery, all of those things are 7-year. Okay, so those two lives are the most heavily used when depreciating business assets because most of them fall within those two lives. Once we determine the life of the asset, now we have to determine what we call the convention. Half-year convention. What the IRS does is they don't allow us to calculate using formulas the depreciation. They create tables of percentages and say, take the cost of your asset times the amount you find on that table, and that's how much depreciation you get. So they have to create these tables with some assumptions because are they going to give you a full year's depreciation the first year? Well, normally when we calculate depreciation in the first year, we say, how long did we own the asset during the year? If we only owned it 3 months, normally we only get to take 3 months of depreciation. Well, to correct or to try to find a common ground, the IRS said, we're going to assume under this half-year convention tables that we create that all assets in the first year were purchased halfway through the year. So if you're a calendar year taxpayer, no matter when you bought that asset during the year, you can take a half a year's depreciation on it. And that's what the tables are already set up to do. Calculate 6 months worth of depreciation. Even though you may only owned it 2 months or 4 months or 12 months, you only get a half a year in the first year. Then you get your 12 months, 12 months, 12 months, 12 months, depending on the life of the asset. And then you'll go into the final tax year with another 6 months depreciation. If an asset is disposed of before it's fully depreciated, you've used all the percentages, you've sold it before its life is up. In the final year, when you sell it that year, you get a half a year's depreciation only. So even if you sell it December 1st of that year, you get a half a year's in the year of disposition. Now, if you buy it and sell it in the same year, no depreciation. Now think about this. You are allowed to take a full 6 months of depreciation no matter when you buy an asset during the year. Right? Now, you start looking for some loopholes with that and you think to yourself, when should I buy my assets? Well, if you're savvy and you can wait, you'll probably wait till December of each year to buy the assets. Why? You'll get a month of use out of them, but 6 months of depreciation. To stop that from occurring, to stop companies from buying everything in that latter part of the year, Congress came up with what's called the mid-quarter convention. And here's what it says. Add up all the basis of all tangible personal property, whether new or used, for the entire year. Only tangible personal property, not real estate. You don't include that in this calculation. In the second step, you add up all of the same personal property you purchased, but only the ones you purchased in the fourth quarter. So that would be, if you're a calendar year, October, November, and December. Divide the total into the amount you purchased in the fourth quarter. If the answer is more than 40%, you cannot use half-year convention to depreciate the assets. You use what's called a mid-quarter convention. So if you buy more than 40% of your personal assets in that last quarter, you're not going to be able to take advantage of a full half years of depreciation. Instead, you're going to use the mid-quarter convention. And here's what that says. There are 4 quarters in a year. Okay. No, and this applies, by the way. If this calculation for a year, and you do this calculation every year, if you are forced into a mid-quarter convention, all the assets, personal assets purchased that year, use mid-quarter convention. So we have to calculate now using 4 different tables, one for purchases in the first quarter, one for purchases in the second quarter, one for purchases in the third quarter, and one for purchases in the fourth quarter. And we'll be seeing those tables in a few minutes. The assumption with this is that you purchase an asset in the middle of the quarter that you originally bought it. So let's say you buy, you have your company for 2017 has to apply mid-quarter convention. You purchased an asset on July 15th. So what we do is we say, okay, what quarter was that purchased in? Well, the first quarter would be January, February, March, then April, May, and June, July. So that's the third quarter. We would use a table that's set up for third quarter purchases. But how that table is designed is it says you will get a full fourth quarter depreciation. So you're going to get to calculate depreciation for October, November, and December. But because you bought this in the third quarter, you're only going to get a half a quarter of depreciation for the third quarter. We ignored January through June. There was no depreciation there. So the assumption is you bought it in the middle of the quarter. You're going to get a half a quarter of depreciation, so a month and a half, and then the 3 months at the end. And that's how it is set up. So calculating depreciation for personal use assets. First, we have to find the life of the, first find the basis. Then find the life of the asset using that revenue procedure 8757. But as I said, it's usually going to be a 5-year life or a 7-year life. Then we're going to see in a second the tables. We select the column that corresponds with the asset's cost recovery. Once we find a table for an asset and a column, we use that same table and column to calculate depreciation for the remaining life of that asset. We never switch to another table. We find the row identifying the year of the asset's recovery period. So what year are we calculating depreciation for? Is it the first year of the life, second, third, etc.? We have to make sure we select the correct table because it could be half year or mid-quarter. And remember, when we're disposing of an asset in the year of disposition, if we used a half-year table, we only get a half a year's depreciation that year. If we used a mid-quarter table, we only get, we have to apply the mid-quarter convention for the year of disposition as well. So there's our table for half-year convention. As you can see, there are many different lives up here, but 3-year. The only thing I've ever depreciating using the 3-year column is a tractor from a tractor trailer. And I worked at a trucking company. Okay, so that's pretty industry specific. But the 5-year assets are across all industries, vehicles, computers, the peripheral equipment. 7-year is your most use and the most activity happens there. Machinery, equipment, furniture. 10-year, I'm not even sure. I think there's tugboats and water vessels. I mean, it's such a unique category. It's for specialized industries. 15 years, so you know, is for land improvements. So we're looking at fencing here. So that could be a common one. Fencing, for sprinkler systems, sidewalks, parking lots, anything under that land improvement are generally in that 15-year category. And 20-year, I've never used, I'm not even sure. I think I remember horticultural structures. Really? You know, so keep in mind there are other lives out there, but it's generally that 5- and 7-year life that you're going to use. Now, if you've determined your assets can be depreciated using half year, this is your table. So you always want to make sure you could reference back to this table. Once you start using it a while, you start memorizing some of the numbers, as I have for 30 years of use. Because remember, this came out when I was in college, so I've been using this 30 years now. Here's your mid-quarter. Remember I said there's various tables. Now, they put all the tables here for the first quarter. As you can see, if it's a 5-year asset or a 7-year asset, the second quarter purchases, 5-year, 7-year, the third quarter, 5-year, 7-year, and the fourth quarter, 5-year, 7-year. Okay, so you will use the quarter of the assets purchase to calculate depreciation when it comes to this. So let me do a real quick example with you, and you have to grab a piece of paper. It's not on our PowerPoint. So let's say we purchase 2 assets. Okay, jot this down. The first asset will be me and my dump trucks. A dump truck for $40,000, and we need to know when we purchased that. So let's say we bought it on 3/1/17. Okay, and the other will be furniture, and that will be for $70,000, and we're going to make that one on 6/1/17. Okay. Now, the first thing we want to do is determine the life of the asset. So we say, is the dump truck a 5-year, 3-year, 7-year? What life? Well, we already talked about this, but vehicles are generally 5 years. So you want to jot that down. Furniture, we already know and we've seen, is a 7-year. So we've defined their cost recovery. We know what column we're going to use. Now we got to figure out what table to use. So we ask ourselves, are any of these assets we bought this year, and assume these are the only 2 assets purchased, personal assets, are any of them bought in the fourth quarter? And the answer is no. So 0% of our personal assets are purchased in the fourth quarter. So there's no mid-quarter convention. Now I know I'm on the mid-quarter tables, so you're going to have to like flash back or check in your book for the percentages we're about to use. I memorize them. Since we don't have to use mid-quarter, we're going to use half year. So I'm just going to write an HY next to my amount. So I know I use the half year table. Now for my dump truck, I'm going to use the 5-year column. So I'm going to go to my half year convention table. First you have your 3-year column. Then you want to go to your 5-year column. You want to go to your all the way on the left, the year. It's first year cost recovery. So it's kind of like using, it's a table. You got to use your column and your row, and where they intersect, that's the percentage you will use. So you can see for a 5-year asset, first year, 20% is the amount you use to calculate depreciation. So dump truck would be $40,000 times 20%, $8,000 of depreciation in year 1. For the furniture, you do the same process. Go to the 7-year column, first year cost recovery, $70,000 times 14.29%, and 70,000 times 0.1429. 14.29% would be $10,003. So that's how you use that table. Next year, when you go to record depreciation for the dump truck, you'll go to your 5-year column again, but now use year 2 row. So you would use 32%. The furniture, you would do the same thing, but go to the 7-year column, year 2, 24.49%. Remember what I said, once your asset has a table and a column, you use that table and column each year. You're just going to go down to the next percentage because it's the next year of cost recovery. Okay, let's just change our example a little bit. Let's say the furniture was purchased on 11/1 instead. 11/1. We know the lives of the asset, but now we ask ourselves, was any of the assets purchased in the fourth quarter? Yes, the furniture. So we have to do our calculation. Remember, we take purchases of personal assets in the fourth quarter. That's in our numerator. So it would be 70,000. Divide that by all personal assets purchased for the year, and that would be 110,000. We're trying to determine if more than 40% of our personal assets are purchased in the fourth quarter, and they are, but let's just, to humor ourselves, take the 70,000 in assets purchased in the fourth quarter divided by the total assets, personal assets purchased in the year, and of 110,000, so 64%. So more than 40% of the assets were purchased in the fourth quarter. That makes us use mid-quarter convention for all assets purchased this year. So how will we calculate the dump trucks? Well, the first thing we ask ourselves is, when was the dump truck purchased? Well, it was purchased on March 1st, so that's the fourth quarter. So the dump truck will use the first quarter 5-year column. So we'll take 40,000, and you could see that one right in front of you, times 35%, or $14,000. And it will always use that column and table. The furniture, which is a 7-year asset, was purchased in the fourth quarter. So we're going to go all the way to the opposite side of our PowerPoint here. Last column, 7 years. First year cost recovery for assets purchased in the fourth quarter. 3.57% is the percentage we multiply the cost by. 0.0357, and I'm getting $24.99. So you can see here that the depreciation is dramatically different between half year and mid-quarter convention. There was something I want to say. Oh, and one thing you got to remember, each year we take the cost, or that basis we determined back in the beginning of the slides, and that's the amount we use to determine depreciation every single year. That amount times the new percentage. One other thing we didn't talk about, and I don't know if you noticed or not, there's no use of salvage values here. Nope, no salvage value. It's ignored when we're calculating maker's depreciation. Okay, so that's just showing you how they come up with those percentages. As I said, in the first quarter, 1.5 months. Oh, this is for disposition. I'm sorry. If you sell an asset, remember what we said. If you sell an asset under half-year convention in the year of disposition, in the year of sale, you calculate depreciation using the percentage on the table. But after the first year, that percentage represents a whole year's worth of depreciation. So you're only allowed to take 6 months of it. So you multiply that result by 50% to get that year's depreciation. What if you're using a mid-quarter convention? Well, the same rule applies. In the first year, it's assumed you bought it in the middle of the quarter. But after that, each year's percentage, except for the final year, but each year's percentage is assuming a 12-month use. So you get a full year's calculation there. Well, if you sell an asset in the first quarter, you're only allowed to take 1.5 quarters worth of depreciation. So that would be 1.5, or 1.5 months, I should say, 1.5 month divided by 12. So you break down that yearly depreciation into months and only take 1.5 months of it for a half a quarter. If you sell the asset in the second quarter, you get 3 months and 1.5 months. If you sell it in the third quarter, you get 2 quarters, which is 6 months and 1.5 months. That's where the 7.5. And if you sell it in the fourth quarter, you get 10.5 months of depreciation. So this is what you use when you are selling an asset that use the mid-quarter convention. How you calculate depreciation in the year of disposition. Remember, if you buy it and sell it in the first year, there's no depreciation at all. So you don't have to worry about it. Take a look. 2017, Scrap Happy purchased and placed in service the following assets: die cut machine $3,500 first quarter, and a computer $1,200 They bought it in the fourth quarter. The cost recovery for the computer is 5 years. The die cut machine is 7 years. So we have computer, we already defined that, and the die cut machine is machinery. Which convention, though, should they use? Well, we do the calculation. There was a purchase in the fourth quarter for $1,200. The total purchases of personal assets in the year, $4,700. So less than 40%. There was a purchase, but it was not more than 40% of all the assets purchased. So we could use the half year still. So we'll take, now we're just doing another one. I thought they were doing the calculation here. What if the amounts were reversed? Well, we saw that already. I went through an example, but here you could see it. $3,500 was purchased in the fourth quarter of all the assets purchased, personal assets of $4,700. So more than 40% were purchased. So you will be using the mid-quarter convention. And they actually go and show you, pretty similar to what we did, huh? I didn't realize this. I read through the slides, but I didn't see this one. So this is good. $1,200 was the amount of the computer. We go to the computer 5-year life, first quarter table, like we did before, 35% of that. The die cut machine was purchased in the fourth quarter. It's a 7-year property. Go to the fourth quarter table, 7-year, 3.57% is the amount we use. So that is personal property and makers depreciation. Real property makers uses mid-month convention and straight line depreciation, and there's only a few lives to choose from. If it's a residential rental, and that's what it should say there, residential rental, 27.5 years. Non-residential property placed in service on or after May 13th, 1993, 39 years. And that's all we're going to worry about. There is another life of non-residential property placed in service before 93 of 31.5 years. But we won't encounter any of that. We're going to focus on 27.5 years and 39 years. On July 12th, Scrap Happy purchases and places in service a warehouse and the land it resides on for $170. $120 is allocated to the building. What is the amount of depreciation on the property for the first year? You only use the $120,000 in your calculation. The land is not depreciated. Please remember that. You go to your table for a 39-year asset. The asset was purchased in July, which is the 7th month. So you will use the 7 month, the 7 column, to calculate all depreciation on that. So in the first year, you get 1.177% of the basis, or $1,412. Who's here? Pat? Sorry about that. I thought there was an intruder in my house. Anyway, the next part talks about some special elections we can take. So what we just talked about is normal maker's depreciation, always available whether it's new or used. Personal and real property, except for land. The next two items are for special assets, and they allow for either immediate expensing. This incentive is commonly referred to as Section 179 expense. There's limits on immediate expensing and in choosing the assets to immediately expense. So we're going to talk about that in a minute. The other one is called bonus depreciation. And right now, they really just started bonus depreciation around 2008, 2009, if I'm remembering my years correctly. And it was used to stimulate the economy. Okay, and it's still being used now. So let's talk Section 179, and that's just the Internal Revenue Code that allows for this immediate expensing. It's out there for tangible personal assets used in a business, purchased, whether they're new purchases or, somebody else used them and they're considered used property. But it's only available for personal assets purchased in a year. It's available in the year of purchase, and in 2017, and a company can expense up to $500,000 under this provision of these asset purchases. It's limited though. Here's your exceptions. There's a dollar for dollar reduction in this $500,000 amount for personal assets purchased over $2 million. So if the company purchases $2.5 million, $2,500,000 in personal assets in a year, they don't have any expensing deduction. And also, this expensing deduction cannot create a loss in the business. So you have to stop subtracting it when you reach a loss. So let's take a look. Company purchased $2.1 million in personal assets. What is the maximum Section 179 the company can take if their business income before this deduction is $300,000? Well, first of all, their purchases were $2.1 million. So we subtract $2.1 million from $2 million of the maximum asset purchase before you have to reduce your Section 179. They purchased $100,000 over that. So that $500,000 maximum is reduced by $100,000. So $400,000 is the maximum Section 179 this company could take in 2017. However, since their income, their business income before this deduction is only $300,000, sorry, I forgot a zero. The company can only deduct $300,000 of that $400,000 as Section 179 and carry the amount not used to next year. They can carry that over. Bonus depreciation. It is available for brand new personal assets, so first use personal assets purchased in 2017. Remember, neither one of these apply to real property. This bonus depreciation is usually taken after Section 179 if any was taken on the purchases, and it is 50% of basis. That is the amount of bonus depreciation. So let's take a look at a comprehensive example. Company purchased the following: a brand new dump truck, there's my dump truck again, $120,000, a furniture that was used for $130,000, and equipment of $670,000. What is the maximum depreciation they can take on these purchases? Now, before we even get started into it, think about the life of the asset and the convention that could be used. So the dump truck would have a 5-year life, furniture and the equipment would have 7 years. None of the assets were purchased in the fourth quarter, thank goodness. So half-year convention applies to all of them. Now, the first thing we do is take any Section 179 available to us. We assume that the company has plenty of profit. That is why I'm taking all the Section 179. I forgot to put that in my slide, but I was going to put it has a profit of $1 million. Okay, so they can take, pick the assets, and we usually pick the assets that have the longest life and don't have any other, longest life that we could. So the longest personal life we have here is the used furniture of 7 years. The other thing is the used furniture doesn't qualify for bonus depreciation. So we're going to use this Section 179 and expense all of that furniture this year. And once we expense all of that, there's no more depreciation calculated on it because we fully depreciated it. New equipment, we're also going to take the Section 179 on because it has a 7-year life. So we usually like to take the long-lived personal assets Section 179 first. But the new equipment costs us $670. We can't take all of Section 179. We can only take that portion that would reach $500,000. So only $370,000 of it will be Section 179. So we get to expense $500,000 right up front. Next, we can take bonus on any remaining assets that are new only and personal. The new equipment, $670,000 was the original basis, but we immediately expense $370,000 of it. So we deduct that. We still have $300,000 of the original basis to depreciate. Well, we could take 50% of that as bonus depreciation. The new dump truck, the whole basis of $120 times 50% or $60,000 is immediately expensed as bonus depreciation. This is only available for both of these in the year of purchase. $210,000 is the total bonus depreciation. After doing that, any remaining basis can then be depreciated under normal maker's rules. So in this case, the equipment had a $300,000 basis going into bonus depreciation. We subtracted another $150,000 of bonus. So there's $150,000 of basis left to depreciate this. We can then go to the 7-year half-year convention table. The first year cost recovery, 14.29%, can be depreciated. Next year, 24.49% of that $150,000. So that basis will be used to determine the remaining depreciation on that equipment. The dump truck, same deal, $120,000 minus $60,000 immediate bonus expensing. So we have $60,000 of basis that can be depreciated over the next 5-year life. So the first year we'll take 20% of that $60,000 or $12,000. Next year it'll be $60,000 times 32%. So the total overall depreciation that can be taken between Section 179, bonus depreciation, and makers for these three assets, $743,435. That's awesome. And that's how it works. The next area deals with special property called listed property. Listed property is property that is used in a business that may have some personal use attached to it. The common items we're looking at here are vehicles and what's the other thing I was thinking of? Phones. But vehicles are the main item. And there's entertainment equipment people can use that maybe they have entertainment items in their business, but they and computers, but they use it for personal use too. But that's what we mainly focus on, are vehicles and computers. Business can use the following step to determine its current depreciation expense for these types of assets. Yikes. I didn't review this slide. Here's how it goes. The first thing we do is determine how much business use does this asset have for the year. So we look at the personal use of the asset versus the business use. If the business use is above 50%, okay, above 50%, you can use your normal makers table to determine depreciation, but you can only deduct the amount applicable towards business use percentage. If your business use falls to 50% or less, you must use special straight line tables to calculate depreciation, and you will use them for the rest of the life of the asset, even if it goes up to 100% business use. Okay, I'm just going to kind of ignore this. Go to the next one. Let me give you an example just to get off that slide. Let's say you have a vehicle in your business. You use it 75% business. Let's not use a vehicle. Let's use a computer. Sorry, a computer, just not to confuse ourselves. 75% business, 25% personal in the first year. Computer is 5-year property. We'll assume a half-year convention. And you paid $5,000 for the computer. Well, since you used it more than 50% for business purposes, you can use that half-year convention table. So you'll go to your half-year convention, 5-year property, first year 20% is the percentage you use to calculate a full year's or a half a year's depreciation, assuming 100% business use. But since you only use it 75%, now take that $1,000 result times 75%. So you only get to deduct the business use portion of the depreciation, or $750. Now, what if you use it less than 50% or 50% or less? Well, you cannot use the half-year convention table. You must use the straight line table. And I don't have it in front of me right now, but give me 1 second. Okay, let me grab that table. I hope it's in the back of the book here. Just see something very quickly before I go there. It's not in there. Okay. Oh, okay. You would take, usually there's a table, but we could use the calculations there. No, we don't have a table. You would take 5,000 divided by the 5-year life, or $1,000, and you get to take a half a year's depreciation. And that's what those calculations are showing you. Okay, or $500. Now, I forget what we said our business use. Let's say we assumed our business use was 45%. Well, you don't get to deduct all $500. So first you calculated assuming straight line, which would be 5,000 cost divided by a 5-year life, because it still retains its life. But now you did it straight line. But just like under the half-year or the table, using double declining balance, we assume a half a year's depreciation in that first year. So it would be 0.5. So 1,000 times 0.5 would give us $500. But now we can only deduct 500 times 45%, or $225. Next year, we would take the 5,000 divided by 5, 1,000. And then we would use whatever applicable business percentage, even if it's 100%. So if you begin using it above 50%, and retain using it above 50% for the entire life, you use the half-year convention table. But if it goes personal use is greater than 50%, at any point you go straight line and remain there. This table in front of you represents the luxury automobile limitations. So you're only able to deduct depreciation on automobiles that are less than 6,000 gross vehicle weight up to a certain amount. So you can own a Ford Fiesta, and it could be considered a luxury automobile if the depreciation amounts you calculate are above these amounts. So let's take a quick look. You purchase a car in the current 2017. You use maker's depreciation, and it is $30,000. And you use it in your business 100%. 100% business use. Cars are 5-year property, and it qualifies for the half-year convention. So you know that up front. So we're going to use the half-year convention table, 5-year property, $30,000 cost. Jot that down, $30,000 cost. So 20% would be the percentage we use. 30,000 times 20% is $6,000. However, and it is 100% business use, so that $6,000 so far is eligible to be deducted. However, there is a limit for automobile deductions, and there it is. Of that $6,000, nope, you're only allowed to deduct $3,160. There's no carryover. You just have to keep applying these limits until you finally record enough depreciation, or you've recorded all the depreciation on the vehicle. Okay, let's change this up a little bit. Let's say this vehicle business use was 90%. 90%. Well, now you take the 6,000 times 90%. You get to deduct 5,400. No, you don't. And you don't say, oh, I get to deduct 3,160. No, you get to deduct 90% of 3,160. So you still have to calculate that maximum by your business use percentage. One more. Let's say that instead you said, oh, the heck with it. I want to take bonus depreciation on this car. You're allowed to. Take 30,000 times 50%. 15,000. Okay. And then you could calculate normal depreciation on the remaining 15,000 of basis of that car. So you would take 15,000 times 20%, which would be 3 grand, right? Yep. So your total calculation would come out to 18,000. And then you look at your table, you go, oh no, I can only deduct 3160. Now look at the little asterisk. You could take 3,000 plus 3160 plus $8,000. So 11,160 is the maximum in that first year if you take bonus depreciation. So this only applies to automobiles that weigh less than 6,000 pounds gross vehicle weight. So the way around this is companies buy vehicles that are more than 6,000 pounds gross vehicle weight, like your Escalades and your Suburbans and your Hummers. Then they don't fly in. Okay, so that was the depreciation on tangible property purchased that you will use for more than a year. What about intangible property, intangible assets? Well, we also will cost recover those. It's called amortization. Intangible assets in the form of capitalized expenditures such as capitalized research and experimentation costs do not have physical characteristics. So an intangible asset can be placed in one of 4 general categories, the first being Section 170 or 197 intangible, a startup expenditure, research and experimentation costs, patents and copyrights. Section 197, those assets have a recovery period of 15 years, regardless of how long their actual life is. So you will expense them or deduct them over 15 years. A full month convention allows taxpayers to deduct an entire month's worth of amortization for the month of purchase and all subsequent months, and you use straight line, no salvage value. Very straightforward. Organizational expenditures and startup costs include expenditures to form and organize a business in the form of a corporation or a partnership and are incurred prior to the starting of the business. Startup costs are costs businesses incur to start up a business. Research and experimentation. To stay competitive, businesses often invest in activities which will generate innovative products or significantly improve their current products. They immediately expense these costs, or they may elect to capitalize and amortize these over 60 months or less. Beginning in the month, benefits are first derived from the research. So they could either expense them or capitalize them and expense them or deduct them over a time period of no more than 60 months. Patents and copyrights. The manner of amortization depends on whether the business directly purchases this or whether it's self-created. Businesses directly purchasing the patent or copyright amortize the cost over the remaining life of the patent or copyright. Businesses receiving self-created patents or copyrights amortize the cost or basis over the shorter of the legal life or the remaining useful life. So it all depends. Okay, and there's a table to summarize how we amortize different intangibles. So it's very straightforward. It's all straight line. You get a full month even if you purchase or purchase it in the middle of the month. So one more time, 197 are things like goodwill, trademarks, patents and covenants not to compete. Organizational expenditures and startup costs are capitalized and expensed over 180 months as amortization. Research and experimentation costs are either immediately expensed or deducted over 60 months or less. Self-created patents and copyrights, self-created, are actual life. That's how they're expensed. Purchase patents and copyrights, the remaining life is the life of or the time period that would be used for expensing. Okay, so it's a long one, but we are finally done with Chapter 10 on cost recovery. Please post any questions you may have.